Wow, look at this. Synchrony Financial SYF. I'm going to look at a new stock for you guys. On inflation report, look at this drop. It opened up at 28.06. It gapped up from 27.43. Then it retraced all the way back down to 26.80. It's quite a swing right there. So let's look at this in historical perspectives. We're looking at 2650-ish, and it hasn't been 2650 since October of 2001 or 2021. So it's trading really low. Its most recent high was $37. So it is down a clean $10 just in a month or so. Okay, let's take a look at some fundamentals before I start messing with it. All right, here's some fundamentals. All right, dividend 3.35. That's good. It's trading near 56 or 52-week low. That's at 26.50 I talked about. Short interest, very low short interest. Look at this, held by institutions, 97%. Institutions have to keep a balanced percentage. So for instance, if you want to keep 10% of your portfolio in Apple, you have to continually buy Apple as money flows in. Okay? So if these institutions want to hold 0.5% of SYF and they keep getting money in from pensions, 401ks, and mutual funds, they're going to have to keep buying. So this is a habitual buyer here. So that's probably who's establishing this 2650 as the low. They probably keep buying shares when it hits that point. Okay, price to earnings ratio. This is positive, which is good, but you don't know how good it is until you look at the peers. I like to compare it to Capital One because this is just a cheap knockoff of Capital One, and they're relatively even here. Look at this revenue versus market cap. This market cap versus revenue. Revenue growth. Not a lot here. These are above average. So it's kind of in the back of the pack for that. But still, Synchrony Financial is, I think it's a solid company. Let's look at some trade ideas. Look at the trades here. So if I say I want to buy it at 26, so I put a cash secured put in for, that's a nice spread. So let's say $30, I could probably get a fill as I'm above the bid and well below the ask. If I put in 30, I'll probably get filled, and that satisfies my 1%. But let me give you a different idea. Check this out. If I bought shares at 26.90, okay, look at the call on this side. Look at the call on this side. So covered calls are safer than cash secured puts. Okay, because I'll own the shares at a 52-week low, a 2-year low, and I'll collect $65 in premium while I wait till May 19th. It'll probably get a fill because it's gonna blast through 27. I believe it's gonna pass through 27. Let's take a look. See, 27. It did hit 27, but look at this clean down here. As soon as it hit 26.50, it bounced right back up to the 27 where it had been for several days. So it's probably going to retest that 26.50 again. I'll do the swing trade idea. It'll cost me a little more capital than the cash secured put, but I don't care. It's a good stock, and that's what buying good stock does for you. You don't mind holding it through some of the ups and downs of the market, not caused by anything Synchrony Financial did. So let's put in $26.94 as my price. Actually, $26.94 is my price. You always want to make sure you get the stock first before you sell the covered call. Because if you put them both in the same time, the call may post before you get the shares. And a lot of people don't have uncovered call capability on their account. I do. You have to take a test for it, actually. So let me put in $65 for this covered call May 19th. I'll pocket the $65, wait for it to bounce above 27. Got my call there. So now I'm sitting tight until May 19th with my $70 and some good price on Synchrony Financial.